Hello, testing, testing. All right. Hello, everyone. Hello, Stockbitters. Hello, all the viewers that watching us today tonight. Before we continue, I want to check our mic. All right. Is it okay? If it's okay, can you guys comment? Hello, Stockbit. Okay. Hi, Terence. All right. So today's session is a session that we uh, collaborate together with Macquarie and Mata. But before that, I want to introduce Stockbit as a platform. Um, my name is Shafiq. I'm from Stockbit, and on behalf of Stockbit, um, Stockbit is a platform with a mission to level up the playing field between retailers and institutional in Bursa. Um, and just a brief announcement, we also migrating our website from stockbit.com to stockbit.my. So those who are still using stockbit.com, right, can use stockbit.my from here on, right? Okay, so today's session is called Technical Overview on US Market 2023 and how to leverage your portfolio via Macquarie US Index Warrants. As I mentioned, this is a session that powered together with Macquarie and Mata. And this session will have two presentation session. With each session will be followed by short Q&A. And without further ado, let me introduce our first speaker. So the first speaker is Aiman Shamsul. He's current vice president for Malaysian Association of Technical Analysts, MATA, former head of the Treasury at Human Resources Development Fund and portfolio manager in Bank Negara Malaysia. More than 10 years of experience in the financial market, covering asset allocation strategy, foreign exchange management, fixed income, and tactical trading. He also have years of experience in teaching F1 academic courses. Without further ado, let's bring him on stage and continue with the first presentation.
Thank you, Shafiq. Thank you so much for the brief introduction about myself. So before we start, I would like to express my gratitude. Thank you to Stockbit as well as Macquarie for inviting me tonight for this evening's program. Basically, my name is Aiman Shamsul, and I am the current Vice President for Malaysian Association of Technical Analysts. So I was informed today that today's focus is actually to look and to share on the outlook for the US market and to look at based on purely on the technical analysis point of view. Okay, so you guys can see the slides, right? Just to check there. All right, so let me click. There you go. All right, before I continue with my presentation this evening, I would like to take a quote from Franklin D. Roosevelt. He mentioned that a smooth sea never made a skilled sailor. Why I chose this quote is because I think this year, 2023, is another volatile year. Exactly like what we have seen like in 2022. The theme is pretty much the same. We see the same narrative, the same sentiments going on. In fact, it's much more people will look and react more negatively to any bad news in the market. So 2023 is going to be a very I would say, very challenging year and very interesting at the same time because I would say we are pretty much in a new regime post COVID 2020. Nonetheless, just a disclaimer, whatever I'm going to present tonight is purely for educational purposes and should not constitute as any investment advice. I wouldn't say to buy or sell any stocks or indexes or any activities, purely as a education. And nonetheless, all investments carries its own risk. So it's important for you guys tonight, who actually in the investment world, to know what are the risks entails with regard to stock market, financial market. All right. So moving on, maybe I'd like to take this opportunity to introduce about the organization that I'm representing tonight, which is Malaysian Association of Technical Analysts. Basically, here in Mata, this is where Malaysian chartists actually meet and speak the same language. This language that we see and talk and we speak to each other is basically talking about technical analysis. So we are purely a non-profit organization incorporated back in 2014, and we are a registered association of under Registry of Societies of Malaysia, and we are actually a member society of IFTA, which is an international organization. So we are one of the society that represent Malaysia. On top of that, we have our Indonesia counterparts, Singapore counterparts, and also Japan. So who we are, our members actually consist of full-time traders, active traders, portfolio managers, both from the institutional side as well as private individuals. And talking about IFTA, which is the International Federation of Technical Analysts, it was incorporated back in 1986. It's a global organization with member societies throughout the whole world. In total, right now, if I'm not mistaken, there are 22 members country, uh, ranging from Australia, Asia, Europe, Middle East, as well as the Americas. So it's purely a non-for-profit federation where they try to gather and to build a platform for all technical analysts practitioner to share their knowledge, their skills, their outlook, and whatever new findings in the technical space. All right. So today, what I'm going to share is basically to provide some sort of flavor what we have seen last year, because for us to chart ourselves for our own portfolio investments for 2023, we need to look back what has happened last year in 2022, and pretty much from there, what is the theme, the key theme that we need to look up for in 2023. So although I am technically a practicing technical analyst, I'm a chartist, I also will look at all these themes, these news fundamentally to make sure that our view on technical actually jive with overall view and narratives, especially from the central banks globally. So for 2022, what we have seen, the key macro theme were rising inflation. It was a tightening monetary policy and growth recovery theme post-pandemic in 2020. So if I'm not mistaken, last time, back in March 16, 2022, Federal Reserve Chief Jerome Powell, he actually made his first action whereby the Fed actually raised its federal fund rate, which is interest rates, since 2018. Initially, it was from 0.02%, 0 to 0.25% bracket. And now we have seen today the Fed fund rate in the US has been ranging 4.25 to 4.5% range. So it has rallied so much. The interest rate hike was increased quite aggressively. And why? This goes back to the question of recovery, whereby during pandemic, it shows a lot of cracks in the economy, a lot of disruption in terms of the supply chain. And because of that, when people goes back to your office, traveling, it caused a lot of pent-up demand, whereby it caused a lot of inflationary pressure. Inflationary pressure, for those of you who are still new in investment term, is purely the price of goods that you purchase today is getting more and more expensive. So to combat that, because a very high inflationary in any economy essentially is very bad and could curtail growth and will lead to a bigger wide cracks in the economy. This is where the central bank like Federal Reserve, even in Malaysia, Bank Negara Malaysia, step in and start to try to fight that pressure. So in the US, uh, they increased interest rates because they want to combat inflation, whereby for US, they have a target inflation rate roughly about 2%. So because of this, it raised the interest rates, which lead to a higher borrowing cost, which pretty much you can see towards the end of 2022, it led to a slowdown in growth. And basically you can see how it impacts most of the risk assets in the US especially. All right. So we've seen 2022, how we started, how market rallied. We look at risk assets, for example, commodities, how it rallied to more than 20% and back to square one and rallied back in December. So we've seen very high volatility in 2022, and I would say this kind of volatility will continue for 2023. And based on that, we see that there's new regime emerge towards the end of 22. This new regime that at play post-COVID 2023 is basically the first point that I can see is actually that it resulted in a less rounder world, whereby last time people talk about globalization, people talk about integration, having a factory in China, having a factory in India, the whole world was united. But now you can see there's a cracks, there's a very jittery relationship between the East and the West. So I would say it's a less rounder world, which shift the theme or the mode of the globalization. And then at the same time, the inflationary pressure still persists, although we see there's a peak end of last Q4, but inflationary pressure is still there. I will show you and share you the chart later on. And lastly, because of an aggressive interest rates hike, it costs the for you or for business to run their day-to-day operations, or for traders to trade in the futures market. It's not cheap anymore. The margin call is high, and the margin requirements are very high. The cost of borrowing getting very high, and because of this, it impacts the whole financial market environment. And the first thing that is impacted from this environment is actually a very low valuation or risk emerge on the risk assets like equities. Nonetheless, going to 2023, we also see that geopolitical risks still there, still happening. You have the US-China tension, you have Europe-Russia tension, US and Russia tension, and then systemic cracks are showing, especially in the Euro region, whereby you guys are quite aware that European region mostly they are in a very bad shape. The economy is in a recession technically. Okay, so for 2023, what are the new emerging themes? Of course, we've seen 2022, it continues. So for 2023, inflationary pressure is still there. And central bank, although the current tone says that, well, we're gonna we try to take it easy, do not be so aggressive, but it is still a hiking interest rates cycle. It's still that kind of mode. There's still hikes. Even Bank of Malaysia, the latest rumors is they're still gonna hike 25 basis points, but still that environment costs a higher cost of borrowing. And then we expect that inflation pressure might moderate, but it will impact overall market. Especially goes to my third and fourth point, whereby there's a question with regard to the outlook and growth in the market because of high borrowing costs, because of inflation pressure. And we've seen also last year, there's an inverted yield curve. Yield curve here that I mentioned is actually relating to the US fixed income market. So in fixed income market, bond market for the US, there's 1 year, 2 years bonds, 5 years bonds, and 10 years bonds. So we've seen that the curve actually inverted. And lastly, it will impact the corporate valuation. So to look at this, this is a chart that I took from Bloomberg as well as JP Morgan Asset Management. This is basically the market consensus and forecast for the GDP growth 2022 versus 2023. And we've seen that somehow for most developed countries like US, Japan, Eurozone, and UK, their 2023 GDP forecast is bad. Is lower than 2022. Nonetheless, we have China, thanks to their they disband their zero COVID policy. They have a pent up demand that we've seen in developed countries back last year and 2021. All right. So from here, we can see there's pretty much like a K economy. One part of the world is in bad shape, slowing down, economy growth are being hampered. But another part of the world, which is in Asia, China, is there to fuel the economic activities. So it's a K recovery. So it's basically just the other side of coin. You just flip it. What we've seen in US back in 2021 and 2022, we are seeing it's happening in China. But nonetheless, for today, we're going to focus more into US market. And before we jump into US market, let's look at the inflationary pressure. So we are still in the very high side, although we've seen a peak at the end of 2022. The global inflationary pressure, this is actually a chart that I took from Bloomberg, which measure the global CPI. Is purely a Bloomberg calculation based on the most recent CPI year-on-year reading for each country globally. They'll take actually around like 98% of global economy. And we've seen globally, the inflation pressure is still there, 9%. That's huge. Imagine year on year, your product, your makanan, your food that you take, it's 9% more expensive than last year. So it's still expensive. So inflationary pressure is still high. Nonetheless, you know, there's a lot of, I would say, there's a lot of room of to work on by the central banks. So from here, that's why the focus now shifts to central banks, whereby for them to tame the inflation, actually based on this chart, it's actually from BlackRock Investment Institute, for them to tame that inflation, it would take a really, really deep recession. What I could say here, but the key takeaway from this chart is to get inflation all the way back down to the target of 2%, which is the dotted green line, that would require the Fed to deal a significant blow to the economy. So it's pretty much an engineered recession for them to really tame the inflationary pressure. So central bank pretty much their policy rates are not the tool to resolve production constraints, because what we've seen all this inflation pressure is because of production constraints. They can only influence demand in their economies. So that leaves them with brutal trade-off on what they can do and what is the impact on the economy. So I did to get inflation back to 2% targets by crushing the demand down to what the economy can comfortably produce today, or live with a high inflation. So it's either you want to have a high inflation economy, or you got to do it the hard way and tame it down. So for now, this is the only options that I personally see that's left for the Fed to do to tame to slow down the inflation pressure. So this, nonetheless, as mentioned, the production constraints actually fueling the inflation and macro volatility. That's why if you look at commodity, for example, why commodity actually rallied a lot is because of production constraints. The supply versus demand, economics 101, you have more demand versus the supply, price will go up. So there you go. That leaves that for example, Federal Reserve, central banks, to raise rates and to engineer a recession to fight inflation. Okay, so that's the theme that we see for 2023. And from there, let us try to validate based on technical analysis. But before we jump into that, of course, for you to really look at where market is going, from that fundamental theme, you have to look at we have to analyze technical view to support that fundamental outlook. So there are a few ways. Normally, for me, in my job, I will look at few asset classes. And first of all, when the talk is about the central bank raising interest rates, of course, we will look at the fixed income, which is the bonds. Then we look at the equities market, and then how does it impact overall in terms of macro view? How does it impact the foreign currency market of that particular country? And lastly, we look at sentiment. Due to interest of time, I think I will just try to cover a bit of fixed income equities, and let's try to look based on technical analysis point of view. So for those of you who are still new, what is technical analysis? Basically, it is a subset of behavioral finance. So what is behavioral finance? It is purely a study of action and reaction of market participants involved in the financial market, be it you or me, be it institutions, be it algo or robots. Basically, we are the market participants. And it also emphasized on the reasoning behind why actually traders, decide to buy and sell in the financial market. It's all about behavior. All right. So where does technical analysis come into play? This is where it's a method or a tool used to measure all these biases in the market, behavior biases, and these biases can be translated into price patterns, trends, and it can use to measure probability of profitable outcome, because it's all pretty much telekinesis is a tool for you to look at what's the best probability for me to enter the market and make money. All right, this is where your biases comes in. And inside technical analysis space, similar to any analysis, like fundamental analysis, there are many tools, there are many ways, there's many routes for you to calculate for certain things. So technical analysis, ultimately, you want to look at the direction. You want to look at whether you want to buy or sell. And for you to do that, of course, there are tons of tools for you to do it. Of course, I'm just going to give you some overview. In technical analysis, the main base or the fundamental of technical analysis is back to Dow theory, whereby you'll study how market goes up, whether it's going to go up, uptrend, sideways, why it turns into sideways, and why there's a distribution or market is going down. So that's the fundamental of technical analysis, basically to spot market trends. And of course, based on the trends, you can analyze based on chart pattern or price movement. So this is where you look at the shapes, the patterns that will repeat over time, over and over again, because of behavioral attitude of financial players. The biases comes into play, translated into price action, and translated into a pattern. On top of that, of course, we try to become to be more specific, more statistical and mathematical um, uh, biases, where we have all this being calculated, whereby we use technical indicators, for example, the leading and lagging indicators such as moving averages, RSI, stochastics. And we have also Japanese candlesticks, yield wave principles, Fibonacci, and Ichimoku trading strategy. So these are all pretty much the tools of technical analysis, whereby you use it as for two purposes. The first purpose is using technical analysis purely to look at the trend, which is a trend followers. They love to look at the trend, or trend predicting, meaning you predict the next move. So it's either two, or you can combine both together. So how do you actually look at technical analysis? Normally, when you look at equity market, usually the usual way when you manage a huge sum of portfolio, it's always to be like a top-down approach. Top-down approach here meaning you look at a bigger broad index, you look at the macro theme, then you slice down to sector analysis. After sector analysis, you choose the best sector for you to invest in, and then you move into the stock selection. So what impacts the buy and sell? Of course, you have the overall trend. Using technical analysis, you spot the support level, you spot the support level and resistance level. You look at the momentum of the price movement, and then you look at the strength and length of the trend. Okay, let's jump into US fixed income market. So why I focus on fixed income? Because right just now we mentioned about Federal Reserve increasing interest rates to fight inflation, and a lot of market activities since last year pretty much dominated by central bank decisions. So for the US Treasury years, US Treasury 2 years, 2 years basically is just the maturity of the US bonds for the 2 year. This is on daily chart. We see there's a small top forming, like a head and shoulders. And the question is whether will there be a big drop lower, meaning interest rate is going to go lower, or actually this is pretty much building a base. If you're building a base, that means there's a large likelihood that prices will rally up further higher. Let me just show you the live charts of the things that I'm showing today. So when you look at US Treasury 2 years, all right. So this on the weekly chart, we can see that there's a potential head and shoulders forming, but there's a base actually being developed for the US Treasury 2 years. Technically, if there's further increase interest rates hike, of course, the yield here, the interest rates over here, going to go jump higher and higher. All right. So from here, we can see that based on technical point of view, it is still building a base, but the momentum has been weakening when we see what happened back in October and October last year to November last year. We see that momentum has been weakening. So, however, we cannot say that there will be a big drop because the current support of 4.17% is still there. So the passage of time with yield going sideways looks like yield is gradually moving below a trend line. So we had a trend line just now in the weekly chart. So the yield is moving below the trend line that began back in December 2021. There's a bit of, there you go. All right. So if the yield for US Treasury 2 years starts to trade below the trend line, roughly about 4.26% and below, given the top that we see here, so there's a risk of a drop to roughly about 3.8% based on the last price action movement, 3.8%. That will build a conviction that if the drop happens, maybe the interest into US Treasuries getting higher. That means because bonds is a risk of assets, that be a risk or I would say a recession might be happening. That's why the interest comes into play. Okay, so that's for US Treasuries 2 years. Then for US Treasuries 5 years, so we're just going to cover 2 years, 5 years, 10 years, and also the inversion that we talked about last year, quite popular. So for US Treasuries 5 years, you can see that right now, the bond yield is trading around 3.54% and it's trading around roughly about the support level. Okay, so is there a break lower? So far, no, because it's being supported by the moving averages, meaning the bullishness, meaning the likelihood of the yield curve, the interest rate's going to go up higher. It is still there. It is still there. All right. So 2 years is sideways, not really conclusive. For 5 years, it is still bullish in terms of the interest rates. So there's a likelihood for it to go up higher. So it is sitting at the December 13 short level. It is sitting here. So whether prices are going to go up higher or not, it depends on whether this moving average 40 still can hold or not. Okay, so that's for 5 years. Next, we're going to move to the 10 years. So for the 10 years, open up. So 10 years, it has a very interesting connotation. When we look at the weekly chart of the 10-year yield, all right, we analyze it back from 1980s movement, 1986. The bond yield for 10 years has been going lower and lower and lower. This also jive with the scenario whereby Federal Reserve provide cheap money or cheap funding. All right, that's why it depressed pretty much the yield from 10 years treasury. And from last year, since the March 2022 interest rate hike, you can see that the yield for US Treasury 10 years has been going up higher and higher. And based on technical analysis point of view, based on chart patterns, a break of this channel, if you take 1-to-1, the next target roughly is about 5%. So it jives back with the story of central bank is still gonna hike the interest rates. So if they're still hiking interest rates, there is always a likelihood that there's always a continuous sell-off in the bond market, and a rally of to 5% is still just few percentage away. This is on weekly chart. Nonetheless, for the daily chart, you can see on a short-term basis, recent movement since the end of last year, October to November, the 10-year yield has been forming, I would say, like a head and shoulder pattern. So you have the shoulder here, the head here, and the shoulder here. And right now, it is trading at the neckline. So neckline is the one that I label in yellow. Okay. So it is trading at a very critical level, whereby if it's going to break lower and lower than the 200 moving average of 3.32%, there's a likelihood it will retrace back to at least 3.2% down here, which is coincides with the 38.2% Fibonacci ratios, or within this range of 2.5%. So if this happen, this is something that I will watch closely. If this happen, I think there be a risk of sentiments across the board. So what do you mean by risk of sentiment? Technically, people will start buying more and more bonds because they are scared, because they want to shift their money to a safer place, and there will be a sell-off in the equity market. Talking about equity market, before we jump into that, remember last year we mentioned about the yield curve inversion, whereby the US Treasuries 2 years and 10 years, they inverted to become in the negative territory. When we look at technical analysis point of view, same thing. The trend has been going lower and lower, and now the inversion is still happening, still there. And the difference between US Treasuries 10 years and 2 years is at negative 0.7%. So on layman term, to put it simply, if you want to borrow money, if you're running companies, borrow money from through bond, you want to borrow in 2 years time, in terms of 2 years maturity, the cost is much more higher than you borrow 10 years maturity. So how does it impact into companies operations? For you to run your company, for your operations, it is actually much costly for you to prepare for your funding. Okay, and the inversion is still there. It's still there. That's why global growth is very, very bad in terms of by the developed countries because of this, right? So you have this. So speculatively, of course, the question is the downtrend in the 2 and 10s starting to flatten out? Because you can see the slope has started to gradually flat out, doesn't move according to the blue line channel. It actually start to move into the yellow line channel. So has it flattened out? So that's a big question. So if this has happened, if flatten out, and usually based on statistics, they show that once the 2 and 10 starts to go back to positive, this is where you have to watch out for. Recession is coming anytime soon. All right. And now, because of that, we look at how does it impact the US equity market. So when you look at US equity market, I love to look at SPX, because SPX pretty much show you the overall 500 companies, big companies in the US. Okay, and from there you can slice into Dow, you can slice into Nasdaq. But US S&P 500 is pretty much the benchmark that you need to monitor closely. So you notice that the S&P 500, there's about 19.4% or 20% drop in 2022. And based on that drop, 20% drop, it was the 7th worst year for the index to go lower, going back since 1928. So this is the 7th worst year of the sell-off if you compare to the history back in 1928. So after a big down year last year, bearish narrative still there. That's why you see people are talking about, recession is coming, invasion is coming, economy is slowing down, IMF starts to produce a lot of bad reports with regard to GDP growth. However, based on statistics also, the XPX is always up 70% of the time in the year immediately after a very sharp down year. So we had a bad year 2022, but based on statistics, when you have a very bad year, the following year, SPX tend to rally 70% of the time. So I'm purely talking about statistics here, because that's one of the topic or scope that we learn in technical analysis. So this is where the question is whether the statistics still hold for this year, 2023, or not. This is where we look at the current trend line. And this trend line has been developed since 2021, where SPX 500 has been going lower and lower and lower, and making August lower high, and December lower high of 4101 points roughly. So right now, it is still trying to retest this downtrend blue line. And in terms of moving averages, it is supported roughly at 50 moving average and slightly higher than 200 moving average. But for us as technical analysts, for us to really call it, the trend has changed, what we need to see is S&P 500 managed to close above at least 2 consecutive days above this blue trend line. And of course, if you want to look at the current short-term trend, the short-term trend is still going up, whereby the low that we see in October 2022, that's the lowest for the last 1 year. And the chart itself, or the price action itself, is making higher low. So you have the low of 3574, and the new low actually occurs around 3780, which is higher than the previous ones. So if this pattern actually moves and continue, whereby you have higher high, higher low, higher high, higher low. If able to break and able to break the previous high, then I would say the trend will continue and will start to move higher. Nonetheless, the risk is still here. And when looking at the bond market, it is at a juncture where, you know, it's either make it or break it. You have this kind of risk. So for me to really start looking at putting my money, I will watch this closely. So we are at the, to be honest, at the inflection point. And nonetheless, overall movement, if you look at on the weekly chart, the whole S&P 500, the whole US equities market are actually at what people call a cyclical circular bull market, whereby they are prone to have a very sharp drawdown, a sharp sell-off, but overall trend, it is still up. From this chart itself, you can see that the overall trend is still higher high, higher low. All right. So, but nonetheless, this is weekly chart in which you have few months leeway or buffer. Anything can happen within this 2 to 3 months. Okay. All right. So nonetheless, another topic that we look at technical analysis is actually on the cycle. And based on statistics, this is what I took from the Bank of America Global Research. In the year 3 of presidential cycle, there's a likelihood that the market actually will tend to go up higher and rally. So this is something that we also will watch out for. Of course, we play with probability. Cycle-wise, we see that market will gonna go up higher based on presidential cycle. But again, we will try to look back at where the market is going here, and we will look closely the inflection point that I told you about, which is this area. Okay. All right. Then after that, let's look at sectors in the US. So when we look at sectors in the US, here to summarize where and how's the performance of each sectors in the US, we look at the what you call it RRG chart. So RRG chart is basically the relative rotation graph, whereby it show you the relative strength and momentum for a group of stocks. So based on the concept of relative strength, it analyzes the question of which sector is the best compared and which one is the worst, and compare it to any other sectors. And there are 4 quadrants. The first quadrant is actually the leading quadrant, whereby we look at the leading sectors in the US economy. We look at the weakening quadrant, looking at weakening sectors in the economy. The lagging one, which is the laggards. So basically, if you want to invest, you don't invest in laggards or weakening economy or weakening sectors. And then we have the improving. This is where you see new values that is coming up. You know, fundamentally, if you look at these companies, actually they are start to pick up their momentums. And leading is basically the momentum play. All the new highs, you go and look at all these stocks. And from here, what I can say is the energy sector, which is here, is under the weakening. So from there, you can tell that actually energy-wise, energy sector like commodities, Brent, WTI, Henry Hub is actually on the weakening side. So do you want to focus on this sector? Probably not. How about the lagging? So on the lagging sector, on the red color, is actually the US consumer discrete, which is at the lagging. So is there any value there? Well, something that you might want to look at it fundamentally. And then when you look at the improving, this is something that interests me most, right? Because this might show me what are the values or opportunities available out there for the next 6 months, 8 months, or 1 year. So we have S&P 500 communication sector or services. And then we also have in the blue color line, which is the real estate sector. We also have the utility sectors, which is this light blue color. So technically, these are more defensive sector like utilities, and it's improving. And leading sector, we have few. We have, of course, the materials. We have the industrial sector. We have the constructions. So these are the leading sectors, but can see their movement are actually going lower and lower. So they start to rotate, and it will shift. Basically, how money flows in equity market, it will shift from one sector to another sector. That's why looking at the cycles, of course, you look at which one is much more interesting and has value. And from there, let's jump into another chart whereby we look at the growth versus value stocks. So here I'm using a proxy, whereby I'm looking at the Russell 1000 versus Russell 2000. So it's just a question of whether you want to focus more on the growth sector, growth stocks. So what are the growth stocks? I guess you guys know the growth stocks will be like technology sectors, such as Apple, Amazon, Microsoft. Those are the growth stocks. Of course, you have Tesla as well, Shopify, and then the value stocks will go back to the normal, FedEx, Walmart. So those are the value stocks. Procter and Gamble or Target, those are the value stocks. So from this chart, you can see that if the chart is going up, that means there's more value for the growth stock versus the value stock. If chart going down, there's more value for the value stocks versus the growth stocks. And you can see based on normal technical analysis theory, Dow theory itself, there's a phase of markup, which is around this area. This is, sorry, not markup, accumulation. This is where people start to accumulate a lot of growth stocks that has been hampered. And you have a phase of markup where you can see that relatively, if you invest in, say, NASDAQ companies versus the normal Dow companies, you can see you have more value in terms of performance. It performs better. So growth stock actually improving. It reached its peak sometime around pre-COVID and dropped a lot. This is where you see a lot of companies like even Airbnb, which is listed in US stocks. Their price earnings are hampered badly. Their price shares also hampered badly. Post-COVID, you can see growth stock starts to rally, like what we've seen in the NASDAQ. You can see most of the tech companies, tech sectors actually rallied a lot. So where we are now is more like an inflection point, all right? So in the technical analysis point of view, of course, if you look at the trend, we are again at the inflection point. If this trend, the current trend breaks and goes lower, that means there's more value if you put your money in the value stocks. And that means pretty much people going defensive. Why people go to the defensive? Probably macro sector is bad. Maybe whatever the banks say right now, I think Bloomberg had a survey, and the consensus that they had is basically they said for the first half of 2023, they see a period of slowdown. There's a risk of recession, but there'll be a recovery in second half of 2023. So if that happens, based on the analysis, if that happens, and we look at technical analysis, we expect that the growth versus value, it'll just move within this way, accumulation before the recovery. Okay. All right. And lastly, to look at sentiments, this is VIX index. And I've been tracking VIX very, very closely. And one very significant pattern that I see in VIX is they love to make pretty much a triangle pattern whereby VIX spikes. So again, what is VIX? Actually, it's a CBOE volatility index. It's a real-time market index representing the market's expectation for volatility over the coming 30 days. So nonetheless, to put it simply, it generally keep track on stock market performance. If VIX index goes up higher, that means stock market fall. If VIX index goes lower, stock market will rally. It's just a fear and greed sentiment. So I've been tracking this closely. For example, during the COVID year, I noticed this trend. It makes this triangle, and imagine yourself holding a spring. So when you hold a spring, when you try to compress it, after a while, you release it, you'll jump. So VIX, I noticed the behavior is like that. You try to compress it, after a while, it'll jump. And you have the risk here, 2008 global financial crisis. You try to compress it again, after a while, it'll jump. This is where you have a small sell-off during the Trump era. All right, same thing. This is COVID year, the huge jump. And where we are for 2023 right now, you can see the VIX has been compressed quite aggressively lately. So we have this line and you have this pattern line. So the bigger question is, based on historical performance, looking at the performance of VIX, when you compress it very, very long and hard, next is it'll just jump higher. So this is something that I'll monitor closely as well. All right. Okay. So nonetheless, before I wrap up, now it's 9:15. Before I wrap up my presentation, when you look at global stocks, of course, based on the macro. So we look at the macro sentiment, the macro views, and then you look at technical analysis. This is where the top-down approach comes into play. You look at indexes, you look at global trends. So the trend now, people talk about hiking interest rates, they will slow down except for China. Then you look at main index like S&P 500. So once you look at S&P 500 or any main indexes globally, then you jump into the sector analysis where you compare which sector you want to look at. And lastly, once you choose that particular sector, the easy win is, of course, you look at the leading companies within that sector, then you choose your individual stocks and apply your technical analysis accordingly. Okay, so to wrap up my tonight's presentation, of course, there's a lot of things that I hope this is recorded. You can just play it again and again. To wrap up, of course, for me, the approach for 2023, it will be a very risky year. Volatility is going to go higher, similar to 2022. Okay, so you have to trade it properly. But unless if you're a new trader, this is a good year for you to test your skills, to see what's going on in the market, and to test your emotions and discipline. All right. So looking at this, you know the theme whereby inflationary pressure is still there, hiking interest rate is still there. Global growth is slowing down lower and lower, except for China. So if you really want to, consider investment, you can look at China or Asia because there's spillover effect. Nonetheless, you look at tendencies to confirm that narratives. So for me, I will combine both fundamental, looking at the macro theme, and I'll look at the technical to look at the current trend and make sure that I can get the right timing. So those are pretty much personal and how people define timing, but those are the tools for you to manage your money and to invest wisely. Okay. Nonetheless, our website, Mata, is at matamalaysia.org, or you can email to mata.secretary@gmail.com if you have any questions. And before I wrap up, I think Shafiq, I'll pass the floor back to you. If there's any questions, maybe I can answer one or two questions to benefit our audience tonight.
All right, thank you for the presentation. We do have few questions from the floor. The first question is from Terence Fu. What are the signs that you look out for before you start to enter a position?
Normally, I will look at my fundamental view. This fundamental view is not about intrinsic value, it's not about valuation. It's purely on the narratives. If the narrative supports a global or positive outlook, then I will look at technical analysis purely on rule base. I will look at the support or resistance, and this is where I define my take profit and risk, which is your stop loss. So the signs I look out for, I look at fundamental. If it jives with my technical, I'll wait for the timing. If my technical say a break, simple way, for example, moving average. If price is above moving average, very much is a bullish market. Price below moving average is a bearish market. But I will look at, for example, where are the support and resistance for me to gauge where is my take profit level, where is my stop loss level. Because at the end of the day, investments are all about risk management. To be honest, investments are all about risk management. And when you have a proper target profit and stop loss, and you can maintain a very good ratio, on the long run, you will maintain in pretty much in this game.
All right. So what if S&P successfully break the trend? We take more aggressive strategy on equity, and just now you mentioned that you look at fundamental first, then technical. What if S&P break, and would that be your first signal?
Normally, I love to put one leg in the market. So sometimes fundamental or narrative will come in later, but knowing the risk ongoing right now, like for example, we know recession might be happening sooner or later. So I won't go for aggressive strategy at all at the moment. I will try to put one leg first, trying to look at the market. But nonetheless, if it's at like the chart I showed you earlier, where S&P 500 is at an inflection point, this is where, like for example, let me open back the chart. Okay, it's at the inflection point. Whoops, let me open back, zoom in. I wouldn't take any positions. I wouldn't risk my money to take any positions unless I have a clear movement in the price chart. So if you ask me, I wouldn't go for any aggressive decisions to either long or short. I will always look at this inflection point because it reaches towards the end part, the end phase of this pattern, all right, this triangle pattern, it will break up or break lower, similar to when we see in some commodities. When you look at commodity market, just now I didn't mention about commodity market, but I will look at few asset classes. So, for example, in copper, all right, copper has rallying a lot higher and higher. Why? Because of China factor, and it's meeting the resistance level of roughly $4.3. All right, so it has been rallying, and copper pretty much risk assets, whereby if economy is improving globally, copper will tend to rally further. So right now, what I see in the market, everything is at inflection point, and I'm looking at weekly chart, not daily chart. The daily chart, there are too much noises, so I look at weekly chart to look at a longer term horizon. So this is somewhere that I will monitor closely, and I have here the buffer from February, January. I still buffer until March and April. So if the narrative about recession is still there, it could be a technical recession whereby, because it's an engineered recession, it can be a short-lived recession. Who knows? But that would be the case if it's an engineered recession. Okay.
All right. So next question is from Terence again. How does US market impact Malaysian market?
Good question. All right. To be honest, I didn't look at Malaysian market for quite some time because I exited Malaysian market for quite a while. So okay, I'm sharing the chart right now. For Malaysian market, FVM KLCI, okay, and most of the Asian market, Indonesia, for example, if you look at the whole overall regression line, this is channel, we are at the low side, meaning there are values. And to answer your question, how does US market impact Malaysian market? Pretty much if there's a recession in US, badly, it will impact globally. In fact, if there's a huge recession or I would say risk of sentiment, a lot of money will from emerging markets especially will pull out and go back to the US, right? But the beauty about Malaysian market is a lot of the foreign money has left Malaysia, and the foreign ownership for Malaysian equities and bonds at a record low. So how does it impact if the huge recession happening in the US? I think Malaysia is still pretty much insulated because of that factor. Because right now, most of the money invested in Malaysian market, MVMKLCI, are mostly from our local firms and farms, like funds, like KWSP, Co-op, Tabung Haji, and the rest. So the trend is still up, nonetheless, on the weekly chart. This is back in 1980s until now, all right? But yeah, the risk is at the moment on the short-term horizon is still bearish. But the value is there. That's why you look at the PE, it's still there. The PE is a price earnings ratio.
Right. Interesting for stock bidders to take note. All right. For next question, how do you see Hang Seng Index after it break through 22,000 point, and has it still have big room to growth in the first quarter? How much you think? So this is more technical question.
Yeah, it is very technical. HSI, where is it? HSI. Okay. Okay, this is a weekly chart. You can see you don't have to analyze in detail, but you can see that Hang Seng has been going on uptrend until recently, until 2020, which is COVID year, and 2021, and then after the political issues happening in Hong Kong with China. So there's a technical rebound because because of China's policy where they open up the economy. So there's a technical rebound. But nonetheless, purely if you look at the trend, the current trend, right? This is a trend that has been developing since COVID year. It has been on the downtrend, and recently it broke up higher. So where's the next resistance? Of course, if you want to be more, anal about this, the next resistance, you can see that this is the last, this back in 2020, there's a sell-off and rebound. Okay, so basically you have this concept of support becomes resistance, and now Hang Seng Index is trading around that range. So whether it can break up higher, that's the biggest question, right? Because current trend, this is the moving average 200, which is pretty much what most big institutions look at. MA200, if you look at CNBC, even Market Watch, MA200 is one of the indicator that people will look at closely. If it breaks higher or lower, there's always a news about it. So I cannot tell buy or sell, but you can see from moving average, where's the moving average and where's the prices. And this is the resistance that you see. So it can be a technical.
Right. So another technical question: do you think it's a good strategy if you enter both long and short at the mentioned S&P 500 inflection point, then close the losing position afterward, let the winning position ride the trend?
I think that one goes back to your own preference. To be honest, me, in where I work before and where I work currently, we're not allowed to do so. It's always about conviction. Whether you're long, you're short, you cannot hedge yourself. A lot of people they love to hedge themselves. Like I enter both positions. If something happens, I cut loss the losers and I ride the whole trend. But from my career experience for the more than 10 years, I don't do that at all. It's always about conviction.
Right, nice and very direct answer. Okay, so as while you interested to know whether is it enough to refer only to VIX chart to know the direction of market?
Okay, VIX charts purely to gauge the fear and greed in the S&P 500. So it is a gauge to look at overall sentiment in the market. Then again, some people they use VIX as a contrarian strategy, whereby if there's a lot of fear in the market, that means I can go and hit and buy because everybody's fear. I'm want to become contrarian. I will buy when everything is falling down falling down from the roof, right? Or sometimes people use fear in greed index as just to gauge whether should I go long in the market because right now it looks like there's not much risk. So it depends. But for me, I will look at as a sentiment tool, purely to gauge the sentiment.
All right, probably last question from the floor is: do you think market will reject the 200 moving average?
There's always a reaction on the long-term chart, weekly or daily, 200 moving average. There's always a reaction there. So there's always a reaction. Uh, so it
So need
depends.
to always follow up with the market lah.
Yep, yep.
Okay, so thank you, Aiman, for very interesting and informative presentation. I'll let you in backstage and let Liana, the next speaker, to go in. Thank you. All right. So for the next speaker, it will be Liyana Majid from Macquarie. She will. She has been part of Macquarie Warrants Malaysia desk since 2014 and involved in the issuance, sales, and marketing of structured warrants in Bursa Malaysia. She also graduated from Purdue University, USA, and was with a local bank as a market maker for exchange traded fund (ETF) listed on Bursa Malaysia before she joined Macquarie Malaysia. So she will cover the topic of how to leverage your portfolio via Macquarie US Index Warrant. Without further ado, let's welcome Liana. Hi, Liana.
Hello, hi Shafiq.
All right.
So can you see?
Yeah, can see your slide. You're not sharing your slide yet. Sorry, you're not sharing your slide yet.
Yeah, correct. I got disconnected just now, so let me just share. Can you see it now?
Yes. Okay.
Okay, all right.
So
Yeah, so I hope my internet will be smooth during my presentation. But thank you so much one of the guest speakers for tonight. I actually really enjoyed Aiman's sessions just now. It was very, very good sharing. So for tonight, let me just introduce myself. I'm Liyana Majid from Macquarie Warrants Malaysia. it's just coincidence that both Aiman and we both studied in the US, and just coincidence that we talk about something about the US today. How coincidence that, right? So yeah, without further ado, we just so tonight's session is just going to be like a very casual sharing, because my turn is going, my slot is just going to be like 30 minutes, and I don't want to like talk something very heavy, because I might have just covered something quite heavy just now. So a few things that I want to highlight, that my presentation tonight is just going to be like a sharing. It doesn't mean that I'm going to So for tonight, my objective is just very short. So we are going to cover about Macquarie's US index warrants, why should consider trading US index warrants, and how investors can use Macquarie's tools to select suitable structured warrants for you. And the last part of the session, I will be sharing about Malaysia warrants and win contests that are currently ongoing. So, so this picture, so this is a picture that is US lah kan. So for those who do not know, Macquarie first launched our very first US index warrants over the S&P 500 way back in 2016. So it was over 5 years. Sorry, from 2016. That time we started with 2 calls and 2 puts over the S&P 500. So over the 5 year span, from 2016 to 2020, we have already successfully listed about 54 warrants over this index, up to end of 2020. And up to this 2020, we remain the only US warrants issuer in Malaysia. And due to good demand from investors, we expanded our product offering with the listing of another warrants over other US indices, which are the Dow Jones Industrial Average Index and the Nasdaq index. So you can see from this timeline, okay, we have already started long for several years, okay, from 2016, 2020, and until currently 2023. Okay, so we have already launched warrants over 3 US indices, okay, the S&P 500, Dow Jones Industrial Average, and also Nasdaq index. So I don't want to explain in detail about these 3 US indices. I'm pretty sure that all of our viewers have already familiar with these indices. Okay, they are very popular all over the world. But in short, S&P 500 is created in 1957. This index includes 500 top companies in leading industries of the US. And this index, it consists of companies listed on New York Stock Exchange and Nasdaq, like Apple, Amazon, and Microsoft. For such as American Express, Coca-Cola, Chevron, and just to name a few lah. So the Dow Jones Industrial Average is often viewed as a strong indicator of the success of the US stock market and the US economy overall. For Nasdaq, okay, Nasdaq, it comprises of 100 US largest and international non-financial companies listed on Nasdaq. Okay, so companies that are among the underlyings included in this index is companies such as computer hardware and software, telco, retail, wholesale. And in terms of the weighting, okay, how the computation method of this index is Nasdaq weighted based on market cap. So basically, what's the difference between Nasdaq and S&P 500 and also Dow Jones is that the Nasdaq is weighted heavily in favor of big tech companies lah. So investors, most of investors knows about it. So usually people ask if they want to have some trading exposures to the US market. So I get asked a lot by investors which indices are better to them, in just in case if they want to have an exposure to the US markets, whether Dow Jones or S&P 500. So usually investors just need to know this index. Okay, like the S&P 500, for example. Why it says the S&P 500? Because it consists of 500 top companies. So it is considered as a better reflection of market's performance because it is broader. It covers 500 companies, so, which are listed all in all sectors as compared to the Nasdaq Composite and also the Dow Jones. So because S&P 500 have more sectors included, it also tends to be more volatile than the Dow Jones. In fact, if we look at the graph, let me just share my screen. Can I confirm that you all can see my screen, the website?
Yeah, can.
Okay, like for example, if we look at the graph for S&P 500, for example, okay, and compare with the Dow Jones Index, okay, graph, in terms of the performance, S&P 500 for the last 5 years, in fact, it has gained over 10%. I'm sorry, internet is very, very slow at this moment. Okay. And also Dow Jones, it have rallied by over 30%. All right. So let's just move on to my slide. So why traders, okay, should consider trading the US index warrants? So similar to other warrants, so these are the advantages that traders can benefit from trading structured warrants. And of course, the main reason why investors trade structured warrants is because of the gearing effect that structured warrants offer. Okay, because structured warrants are derivative products where it tracks the movement of its underlying, so it enables the warrants price to move in a bigger percentage as compared to the movement of its respective underlying movement lah. And because of this gearing effect, it gives investors a high profit potential given the small movement in their respective underlying. But traders have to put in mind that something that has a high gearing, it not only provides high profit potential, it also comes with its risk. Whereby if you buy structured warrants and if you get your view wrong, then it could potentially give you losses as well. So this is something very common lah in the financial instruments, especially derivative product like structured warrants. And of course, US index warrants is also part of structured warrants, so it also give investors this kind of gearing effect when investors trade the US index warrants. And the second reason why investors should consider trading US index warrants is because it requires less capital. What does it mean? Is because structured warrants, it is basically considered as penny stocks lah among investors, because usually the warrants priced are less than 1 ringgit. Generally, the prices of warrants are around 10 cent, 20 cent, 30 cent. So investors like to trade structured warrants because it gives more excess capital to investors to diversify their portfolio. So like for example, if investors have about 5,000 to invest, okay, to trade, for example, so probably they can just allocate about 1,000 to trade structured warrants. And 1,000 in trading structured warrants, you can actually buy a lot of units of structured warrants, and that excess capital you can also buy some other financial instruments products like you can buy stocks, you can buy fixed income and whatever. Okay. um Another things to consider why investors should trade US index warrants is that because it gives investors the exposure to the foreign exchange. Like this US index, investors can get similar exposures to the US market without leaving Bursa Malaysia. Meaning that this US index warrants, it move it has the same movement as the US index. Okay, but you can have the similar exposure without opening any US trading account in the US. You can just use your existing local trading account that you have with your brokers, with your local brokers, and you can just buy such warrants via your trading account in Malaysia. Okay. All right. So another things why US index warrants investors should consider is this is very common lah, bull and bear markets. So the advantage of trading index warrants is because currently in Bursa we have call and put warrants. Okay, call meaning that the warrants move track the similar movement of the market, the underlying index. Like for example, if the underlying index goes up, call warrant will go up. Okay, if the underlying index go down, then the call warrant will also go down. But for put warrant, okay, for put warrant, it moves in an opposite direction from the underlying. If the underlying index goes up, the put warrant will go down. If the underlying index go down, then the put warrant will go up. So by trading index warrants, okay, investors are able to trade either market direction. So this is the advantage of trading US index warrants. And another thing that we want to highlight to investors, why investors should trade US index warrants is because of US index warrants actually tracks the movement of the underlying futures. Okay, the good thing about underlying futures of the US index, like S&P 500, Dow Jones index, and also Nasdaq. Okay, the advantage is that these index US index futures trade nearly 24/7. Okay, from Sunday afternoon to Friday afternoon. So basically it covers the full trading hours of Bursa Malaysia. Like for example, the S&P 500 futures and also Nasdaq futures, they both trade on the CME Globex from, like for example, S&P 500, it trades from 6 p.m. US Eastern Time all the way until 5 p.m. US Eastern Time the following afternoon. Similar to Nasdaq as well. So they trade 24/7. Likewise for Dow Jones futures, it starts trading each day on the Chicago Board of Trade (CBOT) at 7:20 a.m. Central Time. So this is the advantage of trading the US index because of this long trading hours of the futures. So it also covers the full trading hours of Bursa Malaysia. So investors can trade US index warrants from 9 a.m. until 4:30 p.m. During the Bursa during the Malaysia market hour lah. And another thing about the US index warrants is the greater liquidity. The liquidity is very important when you want to trade any securities, any stocks, or any futures, or any structured warrants. Because liquidity will determine whether you are able, when you buy something on the market, when you want to sell it back, it's easy for you to do so. Okay, because liquidity is not something that can be seen in most of the stocks lah, for example. Okay, like, but for US index warrants, they are very liquid. Okay, so like for example, we have our dedicated market maker who always make sure that they will provide the consistent prices and also volume on the bid and ask. Okay, so our market maker will make sure that we will provide the volume at least 500,000 units on both the bid and ask price of our Macquarie's US index warrants. Okay, so most of the time, depending on the liquidity, Macquarie's market maker will put the volume for our US index warrants from 500,000 to 1 million units to 2 million units and to 4 million units. So this, for example, if you can see based on the quantity that we have on both bid and offer price. Okay, so if you want to buy the warrant 1 million units on one instance, you can do so. And for example, if the price of the warrant has already gone up and you want to sell it back, so you want to sell it back at 1 million at one shot, then you can do it so. So this is something that we always highlight when we sell our US index warrants. The advantage is it has a good liquidity, because good liquidity of a financial derivative like structured warrants, it give traders the ability to get in and out of the warrants with ease. So this is something that we always highlight to our investors. So now moving on to how investors want to identify Macquarie's US index warrants. It's actually just very simple. I'm pretty sure that everyone also knows about it. But for those who are not aware of it, so the warrant code, the warrant code of the US index warrants are 0658 for Dow Jones, 0659 for Nasdaq, and 0656 for S&P 500. So these are the short name. These are the short name for the US index warrants lah. Okay, so some investors say that they try to put the code, but they cannot see on their trading platform. Just want to highlight that US index warrants are still under the category of structured warrants, and is not Sharia compliant product. So only investors who have the conventional trading platform are only able to see this code on their trading platform. But for those who have the Islamic trading platform, then unfortunately you are not able to see this code lah. Okay, but this is something that you can see if you just type this code on the trading platform. And this is something that we just something basic that we want to highlight, how you want to differentiate, because there are so many warrants out there on the market, and how you want to know which one. So basically the structured warrants have its naming lah. It will start with its naming. For example, if that warrant track Dow Jones, then it will show the name of the underlying index, and after that it will follow by either C or H. Okay, C represents call warrant, H represents put warrant, and after that it will just followed by any number or alphabet. So basically this stop code and also the naming of the warrants are provided by Bursa Malaysia. So I hope everyone can understand so far. So this is just to recall 4 simple steps on how investors should select structured warrants that are suitable for you. So number one, investors should take a view on the market. Okay, we can practice. We can just take wherever information that Aiman has just shared in the previous presentation, and then you can already know what kind of you can already have a view whether market is going to be bullish or bearish, for example. And if you think that market will be bearish, then you might want to consider then the put warrant will be better lah for bullish values on the index. But if you have a bearish for bullish, then you have to consider call, but for bearish then you consider put warrant. Okay, so number two is you need to set the trading time frame, whether you want to trade structured warrants for about 1 week, for about 2 weeks, or 1 month, 3 months. Then it's up to you. It's based on your trading appetite and your trading preference. And number three is you select structured warrants based on the effective gearing, and number four is the liquidity of the warrant. So this is something that we highlight in our other seminars, but for today I'm not going to cover because it's going to take a lot of time. Okay, so but basically investors have to remember these 4 simple steps, okay, before you decide warrants that are most suited to trade. And Macquarie have a lot of tools that are useful for investors to use on our website. So these, for example, these 3 tools that are suitable for investors. Investors can use, for example, Warrant Search, Warrant Heat Map, and also the Live Metrics Plus that we have on the website. So Warrant Search, for example, we have this is a good tool. I would say that investors can see all the structured warrants listed on Bursa Malaysia. Okay, not only warrants that are listed by Macquarie. In fact, all warrants listed by other issuers on Bursa Malaysia, you all can see this on the website. We can scan the QR code to go to the warrant search, but I'm just going to show our website, for example. So this is our website. You can go to malaysiawarrants.com.my, okay, and then just click on warrant search. Okay, internet is very slow, but so basically investors, you all can just see lah on the website, filter the underlying call and put warrant, and then you can see which stretch of warrant that you want to trade. And another thing is, this is we have on the website, we have warrant heat map. So actually, this warrant heat map allows investors to see which underlying shares or indices that are bullish or bearish in the short to medium term. And from this warrant heat map, investors can see, can take a view whether it's going to be bullish or bearish, and then decide on what type of structure warrants, whether it will be call or put warrant to buy. Okay. All right, so this is the website, Warren Search. So for example, you can just search for SP 500, okay, and then just click on call warrant, for example, and then just click submit. And then this Warren Search, for example, will just show you all S&P 500 call warrants that are listed by Macquarie. And you can see here from this column, the bid volume and ask volume. Okay, so 4 million, so the volume are like 600,000. So it's actually this kind of such warrants shows that they are very, very liquid. Okay, so you can just use this warrant search tools to search for any warrants to find and any other information that you guys want to look for. And from these warrant tools as well, you can go to warrant heat map just to see the graph, uh, for those doesn't have that information or knowledge on the technical analysis, then I will say that warrant heat map will be best for you lah to use, because it has already analyzed for you and provided in this table that is very easy to understand for even beginner traders. And also Macquarie's tools that we have that is important for investors to use, which is our Live Metrics Plus. This Live Metrics Plus shows you where our warrants prices will be throughout the day. Okay, for example, if investors want to buy warrant, and for example, yeah, okay, if investors think that S&P 500 index will go up, then probably when you buy in the morning, the price is at 20 cent. And then if you have a certain target that you think that the S&P 500 will go at certain level, and then you can decide at which price that you can exit. And then after that, from this live metric price, you can also determine how much profit that you can earn within the day. So this is very, very useful. Why we call it as Live Metrics Plus? Because you are able to see the live metrics table for 9 warrants at one shot. All right. Now this is the last part of my presentation. So I would like to take this opportunity to promote the contest that we are currently having, which is the US Index Warrants contest. It is currently ongoing from 1st January to end of next month. So the contest consists of 4 rounds of contest. Okay, it has we have 400 vouchers of Grab worth RM 50 ringgit to be won. So this contest is basically just to test your knowledge of Macquarie's US Index warrants. And if you are among the first 500 participants to answer the questions correctly, then you stand a chance to win a Grab voucher of 50 ringgit. So how you want to join this contest? There are just 3 simple steps. Okay, so first of all, you need to subscribe to our daily newsletter, uh, or you can join our Facebook page, or you can join our Telegram channel. Why you have to do this? Because a link to the contest question will be sent on any of these platforms during the contest period. Okay, so remember, only for the first 100 participants who are able to answer the questions correctly will win a Grab voucher of 50 ringgit. So that's why you have to make sure that you follow either one of these platforms, and and make sure that you switch on your notification so that once we post a link to the contest question, you will be among the first people, the first 400 participants to answer the question lah. So currently our round one of the contest is live, and it will be ending soon tonight at 11:59 p.m. So these are the questions basically. Okay. For each round of contest, we will have very simple questions. So I just give you all the tips lah. So basically, are uh, the answers are already there, either on this platform. So that's why you have to follow our Facebook page or Telegram channel or subscribe to the daily newsletter, because the answers are available on either of these platforms. So these are the questions. So let's say you have already missed out the first round. Do not worry, because there are other 3 rounds that will be coming. So yeah, don't miss out. Okay, so yeah, we're almost at the end of the session. My session will end at 10 p.m. So if there's any question, just feel free to ask me.
Wow, got competition. Okay. So I'm interested to know that if we join every round, we can get 50 ringgit.
Uh, yeah, that's correct. So there are 4 rounds in total lah to be won.
Okay,
But
right.
but if you have missed the first round, then yeah, you just have to make sure that you follow our social media platform to make sure that you'll be the first 100 participants for the next round.
Yeah. So lucky to our viewers lah, right? They might win the 200 crab voucher. Okay. Okay. So let's address the question from the floor. The first question is, if US market is on recession and sell off, will trading a warrant give advantage to trader or investor? Wouldn't it impact volume of market participant in Bursa?
Okay, thank you so much for the question. So, would trading or warrant give advantage to trader? Uh, yeah, that's a very good question actually. So, yeah, as I mentioned in my previous slide, okay, where I talk about the advantage of trading structured warrants, we have US index warrants, have call and put warrants, okay. So the advantage of having put warrants is that because when the market goes down, so the put warrant will go up. So so technically, structured warrants, investors can trade, can have the exposure to the market either both ways. So because like for example, sometimes for stocks, for example, right, stocks investors can only usually will make profit when market is bullish only, right? So when market is not performing, then investors will stay away from trading any stocks, because of course investors do not want to incur more losses in trading stocks. uh, but in contrast, for such warrants, because we have put warrants, so when market is, for example, having recession, investors are still able to make profit by trading put warrants over the US index.
All right. So I guess when market is on recession, put warrant is more attractive, lah, right? And will
Yes, that's
spike the
correct.
volume. Okay, so next question is from SY Liu. Do I have to hold until expire to get money from structure warrant? So this is basic warrant question.
Right. Okay. So here is I would say that I'm not sure whether it's a misconception or what about structured warrants. It's actually investors always think that structured warrants are similar to call warrants. Call warrants, that is the warrants, company warrants, right? Company
Company
warrants.
warrants.
Okay. Yeah. So technically, company warrants, investor like to buy company warrants because they hope that when warrants, because company warrants usually it will be exercised and investors will get it in terms of shares, right? Okay, but for such a warrants, due to difference in terms of the settlement, okay, like call warrants that are listed on Bursa Malaysia, um, right now 100% all of the structured warrants are settled in terms of cash. Okay, so when it is settled in terms of cash, when the warrant expire, there will be uh, there will be a chance that structured warrants will either expire in the money, meaning that when it expires, investors will get back some cash settlement, some the difference of the calculation, that investor will get back the money. But there will be a chance that investors who hold the warrant, when it expire, it will expire without any value. Okay, so that's the calculation for that. So when sometimes investors think that even though they hold the warrant and when the warrant expire they will get back some money, they think that there's a profit. Sometimes you just imagine, sometimes your total cost of buying warrants is 20 cent, but when it expires you get back 10 cent. Even though you get back 10 cent per unit of warrant, does that consider as a profit? No, because your buying cost is 20 cent but you get back 10 cent. So it's actually a loss. It's still a loss, but at least it's not 100% losses. Okay. So basically, you will always tell investors such warrants are not meant to be whole until it expires, because there will be a risk that investors will not get back any money the because the warrant will settle will expire out of money, or doesn't have any return back lah in terms of cash settlement. So there will be a risk of that. So what I would say that investors should usually they will buy such warrants because they want to gain the short term exposure. And when you buy such warrants, usually investors will just sell it back on the market to gain profit. Whenever they see that the such warrants have already made some profit, then they just immediately sell it back on the market.
All right. So the next question, uh, do you mean we could trade US market any time of Malaysia time, or only could trade the US market at Bursa trading hours from 9 to 5 p.m.? So yeah, there's a confusion about the trading hours for warrant.
So right. So such warrants are issued and listed on Bursa Malaysia. Okay. So it will be able to be traded uh, during Malaysia market hours. Okay. From 9 a.m. to 5 p.m. So yep. So like for example, the US index futures are traded, but we cannot trade such warrants right now because it's already at night and Bursa is closed. So you only have to wait until tomorrow and then you can trade such warrants. But the good thing about the US index warrants is because it tracks the futures, the US index futures that is also trading outside of the US market hour, which covers Bursa Malaysia market hour. Okay.
All right. I guess for the rest of the question, because of the time constraint, you guys can refer to our previous live video with Macquarie. We did two session, which is for Bahasa Melayu and also English. You guys can go to this link, um, because most of the question is the question that related to the older video. So I guess we can wrap up for today's session. Thank you, Liana, for your presentation, and thank you for providing us opportunity to earn ang pao for Chinese New Year. Thank you for Aiman and Liana, our panel today, uh, for organizing together this session. Hopefully, this is an informative session that will be very useful for your trading journey and investing journey in stock market. All right, so thank you, everyone. We end this session with a good night. Thank you.